Hello friends, today we are going to discuss about the another part, ethics in financial markets. Financial market is a term describing any marketplace where buyers and sellers are participate in the trade of assets such as equities, bonds, currencies and derivatives. Financial markets are typically defined by having transparent pricing, basic regulations on trading, cost and fees and market forces determining the prices of securities that trade. Some of the salient features of financial markets are transfer pricing, basic regulation on trading, low transaction cost, market determined prices of trade securities. Next, we are going to discuss about the part of that broad topic, institutional markets. An institutional investor is an equity which pools money to purchase securities, real property, and other investment assets or originate loans. Institutional investors include banks, insurance companies, pensions, hedge funds, REITs, investment advisors, endowments, and mutual funds. Operating companies which invest excess capital in these types of assets may also to be included in the term. Activities institutional investors may also influence corporate governance by exercising voting rights in their investments. Because of the sophistication of institutional investors may be exempt from certain securities law. For example, in United States, institutional investors are generally eligible to purchase private placements under Rule 506 of Regulation D as accredited investors. Further, large US institutional investors may qualify to purchase certain securities generally restricted from retail investment under Rule 144A. In Canada, companies selling to accredited investors are waived from needing to file with the Security Exchange Commission. There is also a renewed interest for fiduciary duties of institutional investors and the extension of those duties to environmental, social, and governance issues related to their investments. Institutional investors must often manage assets in the long-term interest of their beneficiaries while taking into consideration in the long-term consequences, both financial and non-financial, of their investment activities. Unfortunately, institutional investors are sometimes confronted with misconduct, wrongdoings, or even fraud that can lead to a significant losses on their investments, which also conf the interest of the beneficiaries. Institutional investors must then consider the available options to recover the value that has been destroyed or a least part of it. Next, we are going to discuss about the another part, regulations for investing in Indian companies. All FIIs, that is foreign institutional investors, are allowed to invest in India primary and secondary capital markets only through the country's portfolio investment scheme, that is PIS. This scheme allows FIIs to purchase shares and debentures of Indian companies on the normal public exchanges in India. However, there are many regulations included in the scheme. There is a ceiling for all FIIs that states the maximum investment amount can only be 24% of the paid up capital of the Indian company receiving the investment. The maximum investment can be increased above 24% through broad approval and the passing of special regulation. The ceiling is reduced to 20% of the paid up capital of investment in public sector banks. The Reserve Bank of India monitors daily compliance with these ceilings for all foreign institutional investments. Compliance by implementing cutoff points 2% below maximum amount of investments. This gives it a chance for caution the Indian company receiving the investment before allowing the final 2% to be invested. Recent government regulation and regulatory initiatives that we are going to discuss. In May 2019, SEBI proposed reducing the overall time taken for right issue from 55 to 58 days to around 31 days. This will make the application and allotment process more efficient. In September 2018, SEBI has reduced the time to list the shares on stock exchanges after initial public offering to 3 days from previous 6 days. A report filed by the panel appointed by Securities and Exchange Board of India (SEBI) on December 4, 2018 has proposed direct overseas listing of Indian companies and other regulatory changes. In September 2018, the Securities Exchange Board of India relaxed the Know Your Client, that is the KYC, requirement for foreign portfolio investors. September 2018, SEBI allowed Bombay Stock Exchange and National Stock Exchange to start commodity derivatives segments. SEBI has also allowed foreign entities to participate in the commodity derivative segment of Indian stock exchanges to help them hedge their exposures. It has also proposed to allow non-resident Indians to invest through FBI route after meeting specific KYC norms. In August 2018, SEBI reduced the timeline for public issue. SEBI reduced the timeline for public issue of debt securities from 12 days to 6 days. Foreign portfolio investors are allowed to invest up to 25% in Category 3 Alternative Investment Funds, that is AIF, in India. Different types of funds such as hedge funds, private investment in public equity funds, etc. are operating in India as Category 3rd of AIFs. Investments by FPIs have been also allowed in Real Estate Investment Trust and Infrastructure Investment Trust. Discuss about the topic insider trading. Insider trading is the word that has many definitions and connotation and which includes both the legal and illegal activities. It can also be described as an insider trading of a company's stock, securities, bonds, and stock options by persons with possible access to non-public information about the company. Nevertheless, insider trading can take place lawfully every day when trading by corporate insiders such as officers, directors, employees, and large shareholders to buy and sell stock in their own companies if this trading will not be taking advantage of non-public information and also be within the boundaries of the company's policies and the rules governing this trading. However, the term insider trading is mostly used to describe a practice in which an insider party trades based on non-public material information gained through the performance of the insider's obligation at the company in violation of their relationship of faith and assurance or otherwise when the non-public information was stolen from the company. In other words, insider trading is buying, selling or dealing in securities, bonds and other stocks of the company by the director, manager or employees of the company who has confidential information that is not accessible to the public. Insider trading in financial market presents various ethical issues including conflicting rights, differing cultural norms, and inequalities across market participants. Typically, insider trading is considered unfair because all market participants do not have an equal opportunity to exploit the information used to execute insider trades. These trades take advantages of favorable information to reap personal monetary gain through large sales or seek to avoid heavy losses from unfavorable information. Insider trading makes those who are not privacy to such information feel powerless and no longer wish to participate, further interrupting the flow of financial markets. The SEBI Act provides for penalties as high as Rs 25 crore or 3 times of the amount of profits made out of insider trading, whichever is higher. The Act also prescribes that insider trading is punishable with a prison of up to 10 years. Next, we are going to discuss is the municipal bonds. Municipal bonds are marketable debt instrument issued by ULBs in India either directly or through any intermediate vehicle with an objective to lend towards projects implemented by the ULBs. The funds raised may be utilized towards implementation of capital projects, refinancing of existing loan, meeting working capital requirement, etc., depending upon powers vested with the ULBs under respective municipal legislation. Short-termism. Short-termism refers to an excessive focus on short-term results at the expense of long-term interest. Short-term performance pressures on investors can result in excessive focus on their parts of the quarterly earnings with less attention paid to strategy, fundamentals, and long-term value creation. Corporations too often respond to those pressures by reducing their expenditure on research and development and or foregoing investment opportunities with a positive long-term potential. This decision can weigh against the company's development of sustainable products or investment in measures that deliver operational efficiencies, develop their human capital effectively, manage the social and environmental risk. Misalignment of interests between the two groups, significant losses for investors can arise. Transaction costs aggravate this problem because a short-term outlook often derives high portfolio turnover. This can lead to high transaction costs, reducing returns to investors. Churning. Churning is the process of executing trades for an investment account by salesman or broker in order to generate commission from the account. It is a breach of securities law in many jurisdictions and it is generally actionable by the account holder for the return of commission paid and any losses occasioned by the broker's choice of stocks. The next one is the topic we are going to discuss is ethics in non-banking financial corporations. A non-banking financial company is a company registered under Companies Act 1956 engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by the government or local authority or other marketable securities of a like nature, leasing, hire purchase, insurance business, cheat business, but does not include any institution whose principal business is that of agriculture activities, industrial activities, purchase or sale of any goods or providing any services and sale or purchase or construction of immovable property. A non-banking institution, which is a company and has principal business of receiving deposit under any scheme or arrangement in one lump sum or any installment by way of contribution or in any other manner is also non-banking financial company. So far, non-banking financial companies have scripted a great success story. Their contribution to the economy has grown in leaps and bounds from 8.4% in 2006 to 14% in March 2015. In terms of financial assets, NBFCs have recorded a healthy growth, a compound annual growth rate of 19% over the past few years, comprising 13% of total credit, expected to reach nearly 18% by 2018-19. A company is considered as NBFC if it carries on as its business or part of its business any of activities listed in section 45I subsection C of the RBI Act 1934, business of making loans, advances or acquisition of shares, securities, etc. or hire purchase finance or insurance business or cheat funds activities or lending in any manner provided the principal business of such company does not constitute any following non-financial activities. One is agriculture operation, second one is the industrial activity, third is the trading in goods, and fourth one is providing services, and the fifth one is the purchase, construction or sale of immovable property. In terms of section 45I subsection F of the RBI Act, a company would also be an NBFC if its principal business is that of receiving deposits under any scheme or arrangement. Thus, a company BIS, central bankers, speeches whose principal business is agriculture operation, industrial activity, trading or real estate business is not a financial institution. These non-bank lenders have become a key sources of loans for those who have risky credit profile and in places where banks does not have the presence through often a consumer of cost borrowing is higher compared to other banks. Currently, NBFCs need to classify a loan as NPA if no interest is paid for 180 days. That period is set to become 90 days in basis in March 2018. NBFCs say this rule would make them more cautious before lending. The new rules through which the RBI is trying to align NBFC regulation with those banks are also likely to dent the profitability of these companies. The NBFC sector meanwhile claims the RBI more would block the flow of organized credit segment from where the banks have historically stayed away, such as financing of used commercial vehicle and construction equipment. Financial services provided by NBFCs can be broadly classified into two categories: asset-based fund services, fee-based advisory services. The important fund-based services include: number one, equipment leasing or lease finance. Leasing an arrangement that provides a firm with the use of control of assets without buying and owning the same. It is a form of renting assets. There is no exclusive law legislation to govern equipment lease financing. The legislative framework and the lease agreement provide the regulatory framework of these financing in India. Hire purchase consumer credit is the second point. Hire purchase means a transaction where goods and purchased and sold on terms that a payment will be made in installment. The possession of goods is given to the buyer immediately. The property in the goods remains with the vendor till the last installment is paid. The seller can repossess the goods in case of default, and each installment is treated as higher charges still the last installment is paid. The third one is bill discounting. Bill discounting is an arrangement whereby the seller recovers an amount of sales bill from the financial intermediaries before it is due. Such intermediaries charge a fee for the service. The fourth one is venture capital. Venture capital is a type of private equity, a form of financing that is provided by firms or funds to small, early stage, emerging firms that are deemed to have high growth potential, which have demonstrated high growth. The next one is housing finance. The housing finance company is yet another form of non-banking financial company which is engaged in the principle of business of financing of acquisition or construction of a house that includes the development of plots of lands for the construction of new houses. The housing finance company is regulated by the National Housing Bank. Any non-banking financial company can operate as housing finance company subject to fulfillment of basic requirements as specified in the Companies Act 1956. The sixth point is insurance services. A financial institution which underwrites the risk of loss of or damage to personal and business assets and life, limb. The insurance companies issue insurance policies to cover a variety of contingencies, that is fire, flooding, breakage, theft, death, etc., involving potential financial loss to the policyholders or their dependents in return for regular payment of a premium. An insurance company operates by pooling risk among a large number of policyholders. Premiums are based on their probability of particular event occurring and the average financial loss associated with each. The seventh point is factoring. Factoring companies are the financing companies that act as a third party in factoring process. They purchase the invoices of the business and provide them money for the unpaid invoices. They charge factoring fees or commission for their services. The important fee-based advisory services are: one is merchant banking. So merchant banking can be defined as a skill-oriented professional service provided by merchant banks to their clients concerning their financial needs for adequate consideration in the form of a fee. The financial services provided by these organizations include loan syndication, portfolio management, corporate counseling, project counseling, debentures, trusteeship, etc. The next one is credit rating. Credit rating agencies assess the credit worthiness of organization and different entities. In simple words, these agencies analyze a debtor's ability to repay the debt and also rate their credit risk. The third point is stockbroking. Stockbroking is a service which gives retail and institutional investors the opportunity to buy and sell equities. Typically, a stockbroking firm will charge commission on the trades it makes on the client's behalf or a fee for retaining its services. We are going to discuss is financial sector reforms of NBFCs. For financial sector reform of NBFCs, a working group of financial companies was constituted in May 1992 under the chairmanship of Dr. A.C. Shah. The major recommendation of working group are as follows. Category-wise classification of financial companies may be abolished and uniform regulation applied to all companies. Regulatory attention by the RBI may be confined to the companies with a net owned funds of rupees 50 lakhs and above. As regard new financial companies, entry norms minimum net owned fund of rupees 50 lakhs and a cooling period before accepting deposits have been suggested. The regulation on asset side, such as limit on credit concentration, capital adequacy standard may be laid down based on the risk assessment of asset and credit conversion factors for off-balance sheet items. The exempted category of deposits should be removed and all deposits should be brought under the regulatory framework. A clear distinction should be made between deposits and borrowings from the bank's institution. NBFCs may be allowed to accept a deposit for a period ranging from 12 months to 84 months. Prudential norms for income recognition, transparency of accounts, and provisions for bad and doubtful debts may be prescribed. Maintenance of liquid assets. Hire purchase finance and equipment lease constitute 10% of deposit, out of which 5% in government securities. And residuary NBFCs constitute 10% of deposit in government securities within the limit of 70% investment in approved securities. Next one is the registration. Companies with net owned funds of rupees 50 lakhs and above have been advised to register with the RBI. Next one is the prudential guideline. The registered NBFCs were required to achieve a minimum capital adequacy norms of 6% by 31st March 1995 and 8% by 31st March 1996 and obtain a minimum credit rating. CAR requirement range from 12 to 15% depending on the principal line of business activities of NBFCs. Next one is the liabilities of NBFCs. The liability of NBFCs consists of deposit from the public, funds raised from the capital market, and exempted borrowings. Acceptance of deposits is related to net owned funds of the company and they are different for different categories of the companies. As per the recommendation of the working group of financial companies, NBFCs with a net owned fund of rupees 2 crore and above are required to register with the RBI. Still March 2005, 573 companies were registered. The size of the capital issues were small, below rupees 10 crore. The SEBI had to 3-year track record and raise minimum paid up capital for listing to rupees 10 crore. Asset of NBFCs. The main task of NBFCs is to continue to play an expanded role as financial intermediaries and widen the capital market offering competition to banks and provide better service and higher return to investor. The achievement of the above task depends on financial discipline and effective deployment of funds. Next topic we are going to discuss is regulations for a non-banking financial corporation accepting public deposits. Public deposit will include fixed, recurring, etc. deposits received from relatives and friends, shareholders by the public limited company and the money raised by issue of unsecured debentures or bonds. Public deposits would however exclude the money raised by NBFCs by way of issue of secured debentures or bonds, borrowing from banks or financial institutions, deposits from directors, incorporated deposits, etc. Some regulation for NBFCs accepting public deposits are given below. The prohibition from accepting public deposits for NBFCs having net owned fund or less than rupees 25 lakhs. The NBFCs are not allowed to do the same, but they can raise the borrowing from other sources. Credit rating requirement and quantum of public deposit. The ceiling of Quantum of public deposit for an non-banking financial corporation has been linked to its level of credit rating, which is given by the approved credit rating agency. Hiring will entail NBFCs to raise large amount of public deposit as per details given below. That is, you can see that from the table, the level of credit rating, the equipment leasing of hire purchase companies, loans and investment of companies. The credit rating is A, AA and AAA. In case of A is concerned, 3 times and 2 times. AA it is 2 times and 1 time, and the AAA 1 time and 0.5 time. Interest rate ceiling. All the NBFCs have now been subjected to the interest rate ceiling of 16% per annum. NBFCs which are offering interest rate excess of prescribed ceiling are required to reduce their interest rate to bring it within the ceiling with the immediate effect. Brokerage. Brokerage payable by NBFCs on deposit of 1 year to 5 years has now been uniformly fixed at 2% against the varying rates earlier. They may also pay the brokerage by way of reimbursement on the basis of will produce an amount of exceeding 0.5% of the deposit allowed. Submission of reports. NBFCs accepting public deposit only will be required to submit RBI annual statutory returns and financial statement. NBFCs not accepted public deposits are exempted from this requirement.